We all know that we can make big profits or losses around major economic and corporate data releases. We're going to look at which ones could move the markets in a meaningful way. Even the staunchest of bears cannot look you in the eye and tell you the job market in the US sucks. It could very well be that the job market is the main reason we avoid recession altogether. You see, after a series of very poor manufacturing data, including the Institute of Supply Managers' Assessment of the Economy, the ISM, that was in contraction territory. The last payroll release in September provided some welcome respite for the market, with an inline figure and a robust revision to previous months. Equities rallied back towards the highs because the data was sufficiently strong to dispel fears of a recession, but not strong enough to derail the expectations of another rate cut by the US Central Bank. Jerome Powell also identified the robust job market in the US as a reason to pause rate cuts here at 1.75 Fed funds level. That is why all eyes will be on non-farm payrolls today. Yeah, it's a lagging indicator, but revisions to the last released numbers have been upwards. Job number is one of the last bastions of strength in a broader US economic picture that is showing some signs of cracks in its foundation. One could argue that a softer payrolls number would be bullish because it would pave the way for another rate cut in December. However, last month, the equity market began its next level up on the back of an inline number just days after that tepid ISM report that had created a bit of a panic. What markets really want is enough signs of economic strength to avoid recession, but also enough uncertainty to keep the Federal Reserve dovish, the Goldilocks economy of middling growth. What's the current forecast? Well, the bar is pretty low. The Reuters poll forecast for the change in non-farm payrolls is a gain of 89,000. To put that in perspective, there's only been a handful of lower readings in the last 5 years. During this time, the average reading was 201,000. The market wants the Fed to see an economy that seems sort of weak, but not falling off a cliff. So therefore, a super weak payroll number, that's a number that falls short of 89,000 forecast, and with downward revisions to prior number, well, that could see equity markets take a tumble. The next rate setting meeting is not until December the 11th, and that's a long time to wait. You see, it's important to remember that with the markets and the economy, it's all about momentum. A very strong number like 200,000 or more, well, that would indicate that the economy is still motoring along nicely. It may take a December rate cut completely off the table, but it will help offset some of the economic concerns we've seen recently. People will be watching as the ISM manufacturing data is released later today. Play this number straightforward. A release that's higher than 89,000 and anywhere up to 150,000, that validates the Goldilocks scenario, and it will be met with a risk-on appetite. Anything between 50 and 89,000, and we should see profit taking in equities, which are at their all-time highs. A strong bid in treasuries, rates lower, and that would keep the Fed in the game for a December rate cut. Below 50,000 is a particularly negative number, and that would put the Fed in a bind. Over 200,000, well, people are going to be looking around and saying, where's the slowdown? Finally, keep one eye on average hourly earnings and hours worked. If the jobs added is strong, but the hours worked and the earnings per hour fall, well, that might indicate that the robots are taking all the good jobs and that workers have been relegated to the menial tasks. The old adage that one economy sneezes and another catches a cold certainly rings true, especially when we're talking about Europe and the US. So it's really important to keep an eye on what's going on globally and not just focusing on the US. The UK continues its saga to leave the EU, writing a seemingly unpredictable chapter each week. Well, that next chapter is now an election on December the 12th. But what effect is all this uncertainty having on the UK economy? Clearly, it's not great. But exactly how bad and what does it mean we'll see in the UK election campaigns? The big upcoming data point is the UK Construction PMI, the UK Construction Purchasing Managers Index. It measures the performance of the construction industry, which is clearly a good indicator of economic activity. And it's something that's been sliding all year and bouncing around recessionary territory for the last few months. This is a big deal because remember, the UK is about to undergo a lengthy process of renegotiating its trade deals with Europe and the rest of the world. So it needs to have a strong economic foundation to negotiate from to get these good terms. These are unnerving times for a typically reliable economy. If this is a weak figure, well, this is going to give the Conservatives and Boris Johnson the ammo he needs to do two things. One, he can tell the country what he's been saying all along, that a fast and efficient exit is the way to go, as all these delays are impacting the economy. Secondly, he could present a sizable fiscal spending package to get the economy back on track. The key here is that the weaker the data, the more emboldened the Conservatives are to announce big spending packages, something they are not historically known for. The clue, after all, is in the name of the party. And while Labour will shout that the situation is the fault of the Conservatives, it will go back and forth. If it's clear that all the parties are going to throw bucket loads of cash at the electorate, well, then we should be pricing for a pickup in longer-term UK inflation. That might finally start to close the gap between the UK and the US 10-year bond yields. This Refinitiv chart shows where they diverged in 2016 after the Brexit vote, after having danced to the same tune for the previous 15 years. So the Fed delivered a 25 basis point cut. This, as we said, was 90% likely, so no shock at the headline level. There was clearly enough evidence for them to cut this time. However, in the statement, the Fed removed the words "ready to act," and instead they will continue to assess financial conditions, hinting that they may pause rate cuts unless anything major happens. This means rate cut expectations in December have decreased, and it's why equities have done well. But again, like we said before, equities are going to struggle to go much higher because they're already so stretched, and it would have to take something pretty sizable to take them to the next leg up. What's the conclusion? The market likes what the Fed is doing, which is to remain on the sidelines for now, given the data they are seeing, and send a message to the world that they see no reason to have a rate cut because basically the economy's doing fine. Sure, there are global slowdown pressures and trade concerns, but that's what the cut was about. For now, monetary policy, as they see it, is well placed, and that's good enough for stocks. What could displace that? Well, for sure, the trade truce falling apart would send equities lower, and it might make them rethink this strategy. But really, as Jerome Powell said himself, it's going to be the jobs data that influences them the most. We will see if that's true on December the 11th at the next FOMC meeting. I'm Jamie McDonald, and we'll see you on the next episode of Before and After.